Hey there, hope you're doing great today. In today's quick video, we'll review the top 4 LP-friendly terms in a syndication structure. But before we dive in, this is just a quick reminder that our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. What are the top 4 LP-friendly structures in a syndication? Number 1 is how the capital calls are structured. Those could be mandatory, which is the least friendly, optional, but with some penalties involved beyond just diluting the ownership share of non-contributing members, somewhat moderate, or the most friendly one is optional with the possibility of dilution should the member who's called upon to contribute capital choose not to do so and someone else steps up instead. So mandatory, optional with some penalties, additional penalties involved, or optional with dilution. Number 2 is distributions of the preferred return. Many syndication structures come with the so-called preferred return, which is usually a set percent based off of the initial principal invested in a syndication that is typically paid, as the name suggests, before any profit splits take place. But what if the property, the business doesn't generate sufficient cash flow to pay the full preferred return that is due during the first year, second year, and so forth of operations? Well, that's where the devil in the details lies. Some syndications are structured in a way whereby if the property doesn't generate sufficient cash flow, that return is lost, it's not paid. Some, and the most common structure actually, is cumulative, meaning that return is not lost, it accrues and it gets paid at the next capital event, whether that's refi or sale of the property. Number 3, and that's the most LP friendly, is cumulative and compounding. Not only does that return accrue, but the unpaid amount is added to the principal investment amount, and any preferred return calculations are based on that higher base going forward. So not accrued, not payable, completely lost, cumulative, or cumulative and compounding, which is the most LP friendly. Number 3 is how the decision making and notices are structured. Specifically, do the LPs have the ability to call a meeting in special circumstances or certain events? And if so, how will decisions be made at that meeting? What vote is required for a successful outcome? And it's important to understand that many times general partners invest in their own deals 5 to 10%, so they are LPs as well. And number 4 is the reporting of distributions as well as notices. Are distributions monthly or quarterly? Typically, they're structured on a quarterly basis, but monthly is more LP friendly, as well as making sure that such distributions are not paid out of existing reserves on an ongoing basis, but rather paid out of cash flow. In other words, you don't want to be in a position where the capital you contributed in the deal is effectively used to pay your distributions. And in that case, it's really a return of capital versus return on capital. And then in terms of frequency or even existence, is how are there notices for any extraordinary or any material events for that matter? If there are none, that's the least LP friendly. Some is moderate, and 90 days or more would be preferred. So in summary, capital calls, preferred return, distribution structured, distribution frequency, source, notice frequency, and voting structure would be those 4 key areas. So we hope you found today's video helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.